This very short video is dedicated to the calculation or the fine-tuning of the perpetuity growth rate in a DCF approach. Here we have a full DCF model with the detailed calculation of free cash flows from 2021 till 2026. And we have here the financial assumptions which enable to get the WACC, the discount rate, and at the end of the day, the enterprise value and the equity value deducting the last available net debt. We know that it is possible to calculate the perpetuity growth rate, whereas at this stage we've taken a customary 3% perpetuity growth rate. We know that, and this is why the formulas here have been reminded. The enterprise value as calculated at the end of the business plan, namely at the end of 2026 for us, is the terminal value without taking into account the discount factor, namely 1 over 1 plus k in the power n. But we know that the enterprise value can also be based on an EBITDA. We could have taken an EBIT multiple. And of course, thanks to this equality, we can isolate G, which is the perpetuity growth rate, which corresponds to this formula. So, in order to apply this formula and to replace 3% by the right perpetuity growth rate as expected by the market, we need to know the EBITDA multiple. We are going to calculate it based on the current year's financial information. I mean that now we are in 2021. We know the market cap and we also have the net debt for the year 2021. This net debt is provided in another sheet of the model, so I'm going to pick it here in the listed peers sheet. And we can see that for 2021, the net debt is less 2,100. So, if we have, which is the case, the market cap on the one end and the net debt on the other end, we have the enterprise value for the year 2021, which is very simply the algebraic sum of market cap plus the negative value of the net debt. We also know in the model the EBITDA for the year 2021. We can easily pick it in the table which is there. And based on that, we can get the EV to EBITDA 2021. EV to EBITDA 2021, which is 11,332 divided by 1,390, which is, with one figure after the point, 8.2. So now we know that X corresponding to what we have here is 8.2. And based on that, we can definitively calculate the perpetuity growth rate. I need to show the last free cash flow because it's taken into account here on the numerator and here on the denominator. So, equals to K, which is the WACC, times X, which is the EV to EBITDA multiple, times EBITDA of the very last year, which is 1,989, less the very last free cash flow, I mean the free cash flow which is expected in the year 2026, namely 7,903, divided by, 793, divided by X times EBITDA, so 8.2 times EBITDA, which is again 1,989, less, plus this time, plus on the denominator, the last free cash flow, namely 793. I close the bracket, and I can see that the perpetuity growth rate, which is expected by the market, is 5.14%.